Hi everyone. It's that time of the year. We are closing to the year end and we are planning financially for the next year and the years ahead, and also planning our taxes, right? So I thought, this is a good time to bring in the three worst investing mistakes that you can make and you need to avoid at any cost so that you don't lose your shirt or you don't lose your capital. As the rule goes, Warren Buffett says, most important, there are two rules of investing. Rule number one, don't lose money. Rule number two, don't forget rule number one. So protecting your capital is as important as, getting the returns from the investments. So the first investing mistake you can avoid is avoid margins and leverages at any cost, like a plague. What do you mean by margins? Now, everyone wants to get rich faster. Everyone wants to make money faster. So margin is an instrument that can amplify your returns, but it carries along a huge amount of risk. It is that you are buying stocks or shares in securities using borrowed money or loaned money. That is, the brokerage gives you money based on the percentage of money that you put in, which gives you an amplified investments on the capital, and the returns also gets amplified enough. Now, but then there is a downgrade. You get margin call, which means if your stocks goes down, in short term, it's highly unpredictable instrument. Equities are highly unpredictable, so anything could happen. It's a gamble. It's like a bet you're taking. And if it goes on the other side, on the downgrade side, you get margin call, and it's nothing but the borrowed funds that you take from the brokerages. They charge a huge hefty commission, 8 to 10% interest on that, and so you end up paying interest on the borrowed funds, and you end up paying much more than what you invested. Suppose a decline of 50% or more from stocks that were 50% margin funded or borrowed equates to a loss of 100% or more in your portfolio. This is because when you get margin call, you have to you owe the brokerage more than what you lost, and so the losses becomes amplified, and this is a best way to lose your capital. So do not get into the leverage aspect. Avoid it at any cost. What is the second mistake you need to avoid? Don't buy stocks on tips or recommendations. Now, 99% of people out there buy stocks. They research so much before buying a television or buying a phone, mobile phone or smartphone, or any vacation. They plan so much, months ahead, and they research so much. But when it comes to investing your hard-earned money, people just buy stocks on recommendation, that too in thousands of dollars. And they listen to somebody in YouTube, they listen to somebody in TV, some analyst gives a stock recommendation, then you go and buy that. And we just saw what happened, right, in such kind of behavior where people just put their money into stocks based on tips. We saw the SPACs, most of the crypto world, all of those NFT, all of those getting collapsed in the last 1.5 years. Even quality stocks fell down 50 or 60%. So that's what happens, right? So if you just don't understand, you don't develop the conviction to hold on to the stocks, and that's the most important problem. Then you end up selling it at a loss, right? So you need to avoid buying stocks on tips. Now, for an average investor or for an average person who cannot analyze stocks, who don't have the competence to analyze stocks, or we don't have the time to analyze stock, it is recommended to follow the indexing or dollar cost averaging through indexing. As Warren Buffett put in my view, for most people, the best thing to do is owning the S&P 500 index. And if you want to diversify a bit countrywide, go for emerging markets, couple of indexes out there. But that's the best way to invest if you're not having the ability to analyze stocks, or if you don't analyze stocks yourself. Now, what is the third mistake you need to avoid? Investing during the FOMO, that is fear of missing out. When the whole bull market is out there, like we just had after post pandemic, every stocks were going up, every SPACs were going up. People get carried away, they put their money into all the fad stocks or the most happening sectors and stocks, which might not be backed by fundamentals, and people get excited to invest during those exuberant times, and that is exactly the wrong time to invest. And when the market goes down, people feel bad and they feel the worst, because it's a wealth effect, and that's the exact time you need to start investing. So you need to avoid the FOMO at any cost, fear of missing out, and get into the markets during exuberant phase. Rather, you should invest in a systematic way across months and years, so that the cost gets averaged out. and diversify enough so that you don't lose your capital. If too much concentrated on two or three most happening stocks you invest into the bull markets, you're definitely going to lose the capital a lot. So that is something you need to avoid as well. So these three investing mistakes you need to avoid margins, avoid investing on tips or recommendations, and avoid FOMO at any cost. If you do these three, your capital at least will be preserved. Even if the returns are subdued, that's okay. The finishing the game is more important. As Buffett said, to finish first, you need to first finish. So it's important to preserve capital. Trust this was helpful. Signing off, Sandeep Anand.